Anne's come on board. Hi, Anne. All right. So many of you, you may have bought your home ahead of the property boom. You may have bought it years ago at a good price, and nowadays your home has become an incredibly valuable asset. You've had the benefit of great tax concessions and of course, like we said, property boom, population boom. So your home is an incredibly valuable asset, but having that home doesn't necessarily guarantee that you'll live a comfortable retirement, but it can. Can't it, Shelley?
It can, yes. and it's something that, you know, is a real conundrum. Well, there's a lot of retirees out there that are asset rich and cash poor. And you're right, Leon, about 80% of retirees these days do own their home. So there are a lot of people in this situation. And our product, a household loan, which is a reverse mortgage product, that is something that can help you access all of those savings that you have saved up in your home. So that's what we call your home equity.
Yeah. Well, we know that around 7 in 10 of our members own their home outright.
Mm-hmm.
Around 15 to 20% have retired with a mortgage. We expect that latter cohort to increase over the next few years as properties, you know, coming in later into the property market and buying later in life at probably more expensive prices initially. Yes. Let's have a look at some numbers here. We've got 8 in 10 own their houses, with apartments and units making up the difference. We've got about 4 in 10 planning to stay home forever. And that's something too, Shelley. We're talking about the home as an asset. It's not just a financial asset. There's a sentimental asset as well. You've lived a life of major family events, memories, you know, special times. And I think one of the beautiful things about being able to access your home equity to fund your retirement is that you can stay in your home and still have that income.
And that's something that we find is really important to a lot of the people that we speak to. It's about lifestyle and amenity and the community also that the people live within. And they've lived there for a long time. They know their way around. They have their friends around them. Families usually close by, and all those things contribute to having a fulfilled and happy lifestyle when you retire. And you know, you work so hard to get there. They are the really important things that are going to keep you healthy and happy. And so, yeah, we do find most people are very reluctant to leave their family home.
And if you ask them to, they want to age in place. They want to stay in their home for as long as possible. Yes. And while probably, let's say, around 40% say that they're prepared to do that both financially and obviously owning their home. But there are sort of around that 60% or here and there who haven't even prepared, or a lot of them haven't even prepared to fund aged care or don't have the means to fund aged care, or maybe they do if they access the equity in their homes.
Yes, that's right.
I think one of the other interesting things too, which we're just looking at the numbers that we get from our surveys, are that just before COVID, around 60% of our members said they felt comfortable and secure in retirement, and 78%, so just under 8 in 10, felt they had enough to fund retirement and remain in their home. Now, during COVID, just under 45% said they feel comfortable and secure in retirement, and 67% still feel they have enough to fund retirement and remain in their home. So now around about 1/3 of Australians, older Australians, are not confident that they'll have enough money to fund their retirement and remain in their home.
Mm.
So and add to that too, the government recently just saying that they expect Australians will need to access the equity in their home to fund an adequate retirement. We're not going to expect any more big base rate boosts to the age pension. The government's probably gone as far as they're willing to go, now knowing that there is value, and now adding that the family home as the third pillar of retirement. So we brought Shelley in today. So Shelley's come on board, kindly agreed to answer some of the hard questions about accessing home equity, because we know there are barriers to accessing home equity. Shelley knows all about them, and she's here to tell you about it. So give us a bit of an overview about how it works.
Okay,
Shelley.
so accessing your home equity, as you said, we've seen a real watershed with the government. They are now also saying that this is something that we all need to consider moving forward into retirement. So how does this actual product work? I like to illustrate how it is like a normal bank mortgage and how it isn't like a normal bank mortgage. So it's not something that is new. It's a product that's been around for quite a while. It has had quite a few changes, which are enhancements, which is great for the consumer, but I'll walk you through those. So it's like a normal bank mortgage in that it is a loan. Okay, so it is a loan that sits on the title of your house. So we would become the first mortgagee on the title of your house, and that's exactly like what would happen with a bank mortgage. Okay. And that's about where the similarities stop. The big difference with this kind of product is that you are not obliged to make those monthly repayments like you would have to with a bank mortgage. You can elect to make those monthly repayments if you wish, but you're not obliged to. So if you choose to not make the monthly repayments, what happens is they get added onto your loan. Okay? So that just frees up some more income for you on a monthly basis to do the things that you want to do and to live that lifestyle that you want to live. So there are some protections built into these products as well. One of them is guaranteed occupancy. So that means that you are guaranteed to live in your home as long as you want to. We can never ask you to sell the home. We can never ask you to leave the home. That's very important. And that's very different to a bank. If you miss a few repayments, they can sell the house from under you. That can't happen with our product. The other thing that's really important is that you also have the protection of a no negative equity guarantee. Now, it's quite a mouthful, but what that means is you can never owe more than what the house is worth. Okay, so you can never go into negative equity. And I think that there has been a perception in the past that these products can get you into a bit of trouble and go into negative equity. So around the time of the Royal Commission a couple of years ago, these new protections were introduced around reverse mortgages, so the consumer can be confident and comfortable in that these things can't happen to them anymore.
And I think, Shelley, that's where a lot of the negative perception of what we would once have called reverse mortgages, and still are often referred to as reverse mortgages, it haven't been cleared up. And I think a lot of people aren't aware of these protections that were put in place.
Do you know, this is actually the most heavily regulated financial product in the Australian market. So rest assured, as a consumer, you are well protected. And look, I remember those times. I remember on a current affair when people were, banging down the doors of the bank saying, how can I owe you more money? We've sold the house. Like, that doesn't happen anymore. So consumers can be very confident in that.
Okay. One of the most common questions we're asked when we produce content around home equity is about the interest.
Yes, of course.
So it pops up consistently. What is the interest rate and how does it compare to, say, other products in similar products?
Okay. So at the moment, we have just actually reduced our interest rate. It's now at 4.95%. And we do get compared a lot to the PLS, which is the pension loan scheme run by the government. At the moment, their interest rate is 4.65%, so it's slightly lower than what ours is. However, there's a big difference between our product and the PLS. With the PLS, you can only draw down a fortnightly amount, whereas with us, you can have a regular drawdown or a lump sum. And with the PLS, it's limited as to how much you can actually borrow. So you need to be of pension age and qualify, and you can only borrow up to 1.5 times the amount of the age pension, okay? Whereas with household capital, you can borrow, it depends on how much equity you have in your home and your age as to how much you can borrow. So they're the two variables that will dictate how much you can lend from us, is your age. And if you're in a couple, it will be the youngest person in the couple and also the value of your house. So those two determinants will dictate to us how much we can lend you.
Okay. We'll get into some eligibility questions shortly.
Sure.
One of the other questions that comes up a lot is, does the interest compound?
Yes, it does.
Okay.
So what that means is that if you, like I said, if you choose to not make those interest repayments, they get added onto your loan every month. And that's that compounding nature. So what ends up happening is you end up paying interest on your interest, if you like. So that's what compounding interest is.
Okay. Now, I think you've touched on this, but what if the interest or the repayments, there's no chance that can outweigh the value of your home?
No, it can't. There's that negative equity guarantee coming in again. So you're guaranteed that that loan can never get bigger than how much your house is worth.
Okay.
Yeah.
And are the interest rates fixed?
No. So the interest rates are variable. So you might find in the past, interest rates were fixed, but I think we've learned from those mistakes. So what that means is if the interest rate is fixed, it takes away all of the flexibility of the product. So that means you can't make repayments, and you actually can't repay the loan at any time that you want to. So they're two features of a household loan that you can take with confidence, is that you can repay it at any time without penalty, and you can also make lump sum repayments at any time. Now, if it was a fixed rate, you wouldn't be able to do those without very large exit fees and penalties. So that's why we keep it at a variable rate. And it also means that obviously the interest rates go down and they go up, but it means that the client has that flexibility, and we think that's very important.
Sure. I mean, like you say, you can either choose to pay it back or you can choose to take it with you.
Exactly.
All right, let's get into some eligibility questions. You touched on age.
Yes.
What's the minimum age?
So the minimum age is 60, okay? And if it's in a couple, you obviously both have to be at least 60.
Okay.
And when it's a couple, we take the age of the youngest person.
All right. Is there a minimum home value?
Look, in all honesty, this kind of product works best when the property is worth somewhere around 400 to 500 at a minimum.
Okay, great. Do you have to fully own the home?
No, you don't. You don't have to fully own the home at all. We are doing a lot of refinancing. And this obviously will depend client to client, situation to situation, as to how much they owe on the actual house, as to whether or not we can help them. But we refinance a lot of existing loans. And the beauty with doing that is that you then don't have to make those monthly repayments like you would to a bank. So we're finding a lot of people really enjoying the relief of those monthly repayments when they get refinanced through household capital.
So they could, if they built up a lot of capital in their home and they owe, say, $100,000 on their mortgage, they can borrow double that from the equity in their home, pay off the mortgage, and then choose to pay off the loan from the equity loan or not.
Yep, correct.
Great.
Exactly. And it offers that flexibility for them as well.
Now, can you only access the equity in primary residence, or can you access the equity in an investment property?
You can access it in an investment property as well. So it works the same. Yes.
Great.
Yeah.
All right. Repayments.
Well, it's flexible. You can make those monthly interest repayments if you want to. And when you go through the process of applying for a loan, we work out exactly how much that is on a monthly basis. And so you can make those. And it's really easy. It's a bit like online banking. You can get online, so you're able to get a password and a user ID, and you get online and you can set it up as a BPay repayment, and you can turn it on, you can turn it off at any stage. So it's very flexible, and you hold the power as to how you manage it. And you can make lump sum repayments at any time as well. The only thing you need to be aware of, though, is that this product does not operate like a line of credit. So if you do make a lump sum repayment, you cannot redraw it again. Okay. And also when it comes to repaying the full loan, you can repay it at any time without any penalty. I always get the question from clients, what if I win tax lotto? Well, then you would want to pay your loan off, I would think, and that is fine. As I said, it's without penalty that you can repay at any time.
Wouldn't that be great? We'd all love to win tax lotto, wouldn't we? Okay, so we've gone through the terms of or have we gone through the terms of the loan? Are there any specific terms that you need to focus on? So how are you paid back once someone, say for example, they take the loan through to when they die?
Yeah.
How is that then paid back?
So it's there's actually no term on the loan in that it's not a 5, a 10 or a 15-year loan. So the loan is, the term is as long as you own the house.
Yeah.
So we get repaid when the house is sold. And the house is sold, I find, for usually one of 3 reasons. You sell the house to downsize or buy another house, you move into aged care, or you pass away. So they're the 3 triggers that usually see a house being sold. But have confidence that if, for instance, if you pass away, there's a year within which to repay the loan. It's not due the next day, it's not due the next week. So there is time for people to get their affairs in order. Yeah.
So if the remaining family wanted to keep the house, they could pay out?
Absolutely they could. And we have seen that happen a few times as well. So they are able to pay out the loan and keep the house.
Okay.
Yeah.
Now, a question that sort of popped up in one of our recent articles was, how can I trust that you won't move the goalposts once I'm dead?
Well, it's interesting because, well, we can't, because we've signed a contract with you.
There you go.
Okay, so even once you've passed away, the contract still stands because the house hasn't been sold yet and we haven't been repaid. So no, rest assured we won't be breaking contracts and moving any goalposts.
All right, so I think you've touched on this, that the assurances that someone can't lose their home are covered by government regulation, as you say, now one of the most heavily, or the most heavily regulated financial product.
Yes.
So I think we've covered that they can't lose their home. Are they in danger of losing any other assets or anything like that? I mean,
no.
In fact, it would seem to me no.
No,
but,
no.
Yeah.
Because we only have a K-bid over the house, so we can't touch any other assets, not at all.
Again, I think this comes back to the perception of how a reverse mortgage once worked.
Yes.
And how if you couldn't pay back, well, then they come after everything else to get their money back. Not the case with household capital.
Not at all. Not at all.
Wonderful. All right, here's another one. I actually thought this was quite an interesting one. What if their house burns down, or what if my house burns down or is damaged by some other event, whilst they owe you guys money?
One of the things that you have to do under the contract is to pay your rates, and the other is to maintain insurance on the house. And this would be the same as if you had a bank mortgage. So you always have to pay, otherwise you're in default of the loan. So if something terrible like that did happen to you, well then it would get paid out and we would all be protected, both household capital and also the client. So insurance must be maintained for the term of the loan.
Okay, so this is a question I've got now just from what you said then. What happens if you do default on the loan?
Then we can call the loan in.
Okay. Simple as that.
Or charge more interest.
All right.
Yeah.
There you go.
Yeah.
Okay, so now the fun part. How do you access the money? And actually, just before we get into that, can you borrow against the equity in your home more than once?
Yes, you can. You can. It depends on whether or not you're taking the maximum of your loan. I find a lot of clients don't take the maximum, so that if they find that in another year or two, they'd like to come back and borrow some more, they just reapply for another amount. So that's one way to do it. The other thing is, if you do take out your maximum loan, every year you get a year older, your capacity to borrow more increases. So it grows by 1% per annum. For instance, if you're 60, you're able to access 15% of the value of your home. And when you're 61, you can access 16% of the value of your home. So you can see as you get older, you're able to access or unlock more of that equity.
And I suppose with every year, in theory, the value of your home increases, you've got more access to more equity.
Exactly right.
Okay, so how do they access the money?
Okay, so we can do it one of 2 ways. Is you can either take it as a lump sum, or you can take it as a regular drawdown, and they can be fortnightly or monthly, or you can take a combination of both, a drawdown and a lump sum.
And you facilitate the drawdown?
Absolutely. It just magically appears in your bank account every month or every fortnight.
It's like a second pension.
It is like a second pension.
Do you put any limitations on what the money can be used for?
We do. So we have 5 purposes that we will lend for. And they're so refinance, like I said, so that's just refinancing an existing mortgage over your house. We've also found that we've been, particularly over COVID times, refinancing a lot of credit card debt. So that's been popular, and just people cleaning things up. Another reason is top up, and that is to top up your income. So that's that regular drawdown. And also if you wanted to top up your superannuation. Another purpose we call is live. So that's renovating your home, or maybe purchasing a new car, or looking to do some travel. Not yet, very soon we hope.
We hope.
Yes. Giving is another purpose. So this is talking about giving to your children, and it's usually for one of two purposes, and that is for school fees for grandchildren, or also to help with those first home buyers deposits as well. When you have a look at intergenerational wealth now, I mean, most people aren't getting inheritances until they're well into their 60s, and that's not when there's the most need. I mean, kids usually need it in their 30s to 40s. So we're finding a lot of retirees are bringing forward that bequeath and lending them the money via their home equity.
Yeah, that's one of the major, I suppose, barriers that we see in our communication with our members, is that people are wanting to leave their home to their family as an inheritance, which is something that their parents may have been able to do for them and parents before. But I think the difference between now and, say, 30 years ago or 40 years ago is that a lot of these children, I'm not going to say all, but these young adults or older adults have had the benefit of pretty much a full working life of compulsory superannuation.
Yeah.
So whilst admirable, and don't get me wrong, it's a wonderful premise to leave your inheritance in the form of a home to your children. If you're living incredibly frugally or not as comfortably as you possibly could, if you had access to more income, waiting until they're so much older seems counterproductive. Yeah. If they don't need it, then if they need it for helping their kids with education, or getting into the housing market, or helping them through debt or tough times, and you can do that now, then it's almost like like you say, it's just simply bringing it forward.
And we have found during COVID times that some retirees' children have fallen into tough times, lost their jobs, unable to pay rent, so kicked out of their apartments or homes, and so they have come to us to access some money to help their children. So it's been really heartwarming to know that we've been helping them. The other purpose that we also lend for is care. So that's to help access aged care, but also to help access in-home care, which is much more popular than aged care at the moment, not surprising. So that's to help, fund any help you need in the home, but also hand in hand with that goes quite a few renovations. If you perhaps you've broken a hip and you're coming out of hospital and you need to put in a new bathroom, or alter your kitchen, or put in ramps. So yeah, we've seen a lot of those sorts of loans as well. So we won't just lend for any purpose, but we certainly do cover off most purposes that retirees need money for.
Okay, so is there lending for reinvestment? So could you borrow against your property to purchase another property? Is that something that you allow, or is there a limitation on that? Or
we have lent to help purchase a new property. So yeah, no, that is something that we have been doing. Absolutely.
Okay. Now, I suppose this is a bit of a tricky question for you.
Oh, I hope I can answer it.
But well, we said we'd ask the tough questions.
Okay.
What are the downsides?
Well, I don't know that there really are any. There used to be, but as I said, we've got these new protections now in these loans. So, and the way that we lend and the actual amount that we lend is conservative. So it's not like lending 15% of the value of your home when you're 60. That's not going to get you into a lot of trouble by the time you're 80. So I can't see the downside.
Well, I suppose as much as the benefits are subjective,
yes,
so too may be the downsides.
Yeah.
But I agree. I think if you've got the equity in your home and you have the ability to access it, to live a comfortable retirement, to not worry about turning on the heat or having to pay your water bill or eat that week. Obviously, these are extreme cases.
So we do come across them.
You would.
Yeah,
You would
do.
indeed. And you would come across a lot of people who would never consider accessing their home equity because of, like we've covered, the negative perceptions of reverse mortgages and the absolute, I suppose, must leave my house to my children in the form of inheritance.
I suppose you're right, Leon. I suppose that is the downside. And I have come across this once or twice, is people not telling their kids what they're doing. So they're going to get a surprise when mum or dad pass away and there is a loan outstanding on the home. That would be the only downside, is that obviously the equity that is going to perhaps be left to someone's being used. But it's all attitudinal. And
Absolutely. All right, so we just found out last week, I think it was last week, that access to the pension loans scheme, why is it such a tongue twister today, has doubled since COVID. So I think you've touched on the main differences between accessing home equity with household capital or accessing the pension loan scheme. Can we just get those in a bullet point again?
Yeah, sure. So our interest rate, 4.95. I'll call it the PLS. So the PLS.
Let's go with PLS.
Okay,
way easier to say. It rolls off the tongue.
Interest rate 4.65. Household capital, how much you can lend. That is determined by your age and the value of your home. Whereas with PLS, it's 1.5 times the pension. With household capital, you can take out a lump sum. With PLS, you can only take out a drawdown fortnightly. With household capital, you need to be at least 60. With the PLS, you need to be
Of
pension age.
Yep.
Yeah. So that can differ depending on your age.
Okay.
Yeah. So they're the major differences. Oh, and with us, the process from start to finish is around 4 to 5 weeks, depending on how good the client is with the paperwork. And we're hearing with PLS, it can take 3 to 9 months.
Wow.
Yeah. So, and you deal with Centrelink or you deal with me.
Which one seems more fun to you?
I answer my phone too.
Ooh. Okay, so we've got some questions coming through. I've just got a couple more questions that we've had before today from our members. So we're talking about now, which something we touched on before. We're saying that the government's given what we could probably call assurances that the family home will not be included in the income and assets test anytime soon. We don't know. We don't quite know what anytime soon means. It feels like it's only a matter of time before it is. We're all eagerly awaiting the outcome of the retirement income review, so we'll sort of have probably a bit more of a roadmap towards that happening in the future. So currently, the family home is exempt from the age pension assets test, which means that a lot of older Australians or pensioners can live in their home modestly on the age pension. So for those people, if they were to choose to access some of the equity in their home, how does that affect their pension?
Well, it can affect their pension, but it depends. So it depends if they have any other significant assets sitting outside of the family home. For instance, a bundle of shares, a share portfolio, an interest in a family trust. They're the usual assets I find that will kick someone over the assets test. Now, they're quite generous, the assets test. I have written them down. For a single pensioner, it's $268,000. And for a couple, and this is for homeowners, and for a couple, it's $400,000. So you need to have assets greater than that before your pension will be affected. Most of the clients I talk to fall well below that threshold, and so drawing down equity out of their home has not affected their pension at all. I can always give those guidelines. I can't give that advice though, but usually they're so far under the guidelines, they're quite confident that they're not going to get into trouble. But I always encourage people to go and just check with Centrelink if they're unsure.
Okay, great. All right. This is a question for you.
Mm-hmm.
In your dealings with people contacting you, what is the most common question you're asked, or the most common barrier that people face before, or that they have to jump before accessing their own home equity?
The barrier. It's the attitudinal one.
Okay.
It's getting their head around that this is really a vanilla product. It's a loan. So it's not scary. It's just a loan that sits over your house and it can be repaid at any time. And once people have confidence that it's quite a vanilla product, they can move ahead quite easily.
Beautiful.
Yeah.
All right. Now, they're most of the questions that we've had from our members before today.
Right.
Now, we've had some streaming through on our little chat window down there. So if anyone still wants to ask a question, jump on the little chat box down the bottom there, ask away, because we're about to give them a bit of an answer, a Q&A session. Shelley, are you happy for me just to sort of read some out to you and see what you can answer? And of course, if Shelley can't answer them today, we can have someone contact you and get back to you and give you the answer. So let's start with Diane's question. Now, Diane has said, my husband passed away in October. I've paid all my super into our house, which she only owes $27,000 on now. Mm-hmm. Congratulations in one respect. If she pays it out now, how can she use the equity of her home for some more money? I think we've covered this, but do you think you could answer that a bit more directly for Diane?
So Diane, we would need to see the mortgage repaid, and then we would just work out the LVR and how much we could lend you, and you would apply for however much it was that you wanted to take out. Obviously, you don't have to take the maximum loan. So that would be completely within the guidelines of one of our loans.
Okay.
We'd be able to help you.
Great. All right. This one's from Kevin. Kevin has asked, is the capitalised interest tax deductible if the equity release proceeds are used to acquire income-producing assets?
I think they would be.
Yeah?
Yeah.
Okay.
I think they would be.
There you go. Short answer
You'd
is a good answer.
obviously have an income. You would have an income to offset it against, so I'd have to double check, but I think so.
So Kevin, if you don't mind, we'll get back to you on that one, but Shelley says she thinks so. All right. David has asked, highest LVR?
45%.
There you go, 45%. All right. Michael is 65. He has a clear title to his house worth $3 million.
Wow.
He would like to borrow from Household Capital and also participate in the pension loans scheme, which has superior features, but Household Capital won't allow it. Is that correct?
Yeah, just because we like to be ranked first on the title of the house.
Okay.
Yeah.
Okay. So he's saying they lodge a caveat, but you won't allow it. That's right. Okay. Yeah. So that's why.
Yeah.
Okay. Yeah. All right. Warren has asked, do you need to pay a loan repayment or is the whole thing capitalised?
So what do you need?
He said, do you need to pay a loan repayment or is the whole thing capitalised?
Up to you. You can make repayments if you want to, but you don't need to. So completely in your control.
Beautiful. Okay. Julie, what are the setup fees, if any?
Good question, yes. Okay, so our setup fees are 1.5% of the loan. Okay. So what that covers is evaluation, conveyancing, legal documents and settlement. The only expense to you, the client, is when it comes to documentation phase and signing the mortgage contract, you need to go and see your solicitor for advice. So that's the only out-of-pocket expense to you. Everything else is wrapped up in that 1.5% fee, and we actually add that onto the loan. So it's not like you need to put your hand in your pocket and come up with that 1.5%. It gets added onto your loan.
Okay, great. All right. Ali has asked if the equity is in the Yes, sorry, it moved about a bit. We've got it. If equity is 70,000 and age is 71, how much can I borrow? Is that a little bit too?
Yeah, I'd have to get back to you.
Yeah.
Yeah.
I think we're giving some general advice and information. So if we want to find those sorts of things out, best to contact Shelley.
Yeah.
We'll give you those details shortly. Okay, we've got Diane. All right, this may also cross over from general into personal.
Yeah, I'd need to run some numbers on that one.
Diane, we'll get Shelley to run some numbers and get back to you on that one. Just so everyone knows, Diane's just wanting to know specifics about repayments on borrowing. They're the sort of questions that we're better off answering one-on-one.
On a one-on-one basis, for sure.
Yeah. Okay, Julie, another good question. How is the home valued? Who values the home?
So we use independent valuers. So they make an appointment to come and see your home and they value it. So, yeah, they're not owned by us. They're independent. So,
okay.
So the easiest way to do it.
Could an applicant cross-check the valuation of the home with say maybe someone that they've bought in, or no? Okay.
No.
Yeah.
It needs to be. We have a panel of valuers that we use, and we.
Of course.
It can lead to all sorts of arguments otherwise.
Yeah. We're trying to make the process as smooth and as simple as possible.
And also at arm's length as well. Yeah. So it's not us influencing or the client influencing. It's an independent valuation.
Okay. And Michael's actually asking some follow-up questions. Michael, what we'll probably do is we'll put all of these questions together and we'll have Shelley or someone at Household Capital respond to you in kind.
Sure.
It's a completely general question. Sorry, Michael.
I do see what you're saying though about case. Sorry. So that, yes, the PLS. If you've got a household loan, you can take out other loans underneath it.
Okay.
Yes.
Great.
PLS. Yes.
All righty. So, do we have any more questions from the panel? Ali's typing, furiously typing. Michael's typing. Some others are typing. Oh, we're having the final the rush of questions. Are these questions you come across often, Shelley?
Yes. Yeah, they are.
Which is why you can answer them off the top of your head. Okay, so Julie's come back and asked, who pays for the valuation?
So that's included in your 1.5% fee. Yeah. So that you don't have to pay for that out of your pocket. That's, like I said, that 1.5% establishment fee that's added onto the wine.
Okay. And a rephrased question. At the age of 71, what percentage of equity can be given?
26%.
There you go, Ali. Mary has asked, are you located in Victoria?
Yes, I am.
But you do everything via, so the process is call or access through a website?
Yeah, so what the process is, usually a discovery call, off just a phone call initially, just to answer any questions and just to see if it's something that might be appropriate for your situation. And then we move through to a Zoom meeting. So I'm dealing with people all around Australia. And it's been great during COVID. It means it hasn't changed the way that we've been doing business now for a good 12 months. And then from after the Zoom meeting, once the client's happy and wants to proceed, then we move to an application phase where application forms are sent through. And then the various documents are sent back. You move through to credit assessment. And then once that's approved, we move through to settlement. Yeah.
Great.
So that's the process.
Get through that quite quickly.
Yeah, I'm saying that all very quickly, but
yeah,
there's a few steps along the way, obviously.
Yeah, and a little bit of background, a little bit of digging to do. All right, here we go. Please confirm I can borrow from household and then from PLS. No,
I'm pretty sure you can. I'll have to get back to you, Michael. I'm pretty sure you can.
Okay, Michael, Shelley's going to get back to you. Okay. David Vickerman, all funded by
ME, yes. So David, you're on the ball. So our funding comes from ME Bank, and ME Bank is the industry super bank. So yes, that's who we are getting our funding from.
Okay.
Yep.
Great. Now, okay, well, Diane's come. Now you're going to get the age and what percentage of equity. Diane's come at the age of 66. What percentage of equity can
21.
she have? 21%,
21%, Diane.
There you go, Diane. You were saying before, Shelley, throughout COVID, you've had a lot of interest. Travel
Yes. Yeah.
has been one of the big reasons for people contacting you.
Yeah. So a lot of people are starting to plan travel again because they're one, probably a bit frustrated, and two, a bit bored. So I've organised some holidays and got some great ideas. So yes. And another really big focus has been renovations. People living within their space and dreaming about enhancements or finding things that don't work and don't want to live there with these things not operating properly. So renovations are also something that we're seeing quite a few requests come through for during this time.
Do you think the pandemic has led to a shift in thinking about leaving the equity in their home or accessing the equity in their home? Have you found that there's been maybe a little bit more of a tendency to say, you know what, bugger it, I'm going to do this?
I think so, because, we've never been in a situation like this before. And, people are getting unwell, and you look overseas and people are dying, and you sort of think, oh, gosh, I'm going to make these years count, and I'm going to do the travel I want to do, and I'm going to live my life the way. I'm not going to make those sacrifices anymore if I don't have to. So I think there's been a real attitudinal adjustment. This is my time. This is what I want to do, and I'm going to do it. Absolutely, Leon. I really do. And I've even seen that with my own family.
Well, they say, isn't it, people are living longer, but life's still too short.
Absolutely. Absolutely.
So if you can, why not? Okay, we're about to wrap this up. So if anyone's got a question, get it in now. Shelley, it's been really great having you come in today.
No, it's been exciting to get out of the house. And thank you for the opportunity, Leon. It's been lovely to converse.
No worries.
And reach out to your clients.
Well, Household Capital is one of our preferred partners, and we love the guys. We love the product. We think it's fantastic. We think there's a lot of potential to make your retirement more comfortable, much better, happier, certainly. That's not to say it isn't already, but for some, it could be